Welcome to our channel Ayakar Kamkar. In this video, we are going to discuss how to save tax on long-term capital gains for assets other than house property. For example, let's assume you have sold some foreign shares, and to save tax, you need to make investments. First, let's take section 54F. This is related to investment in house property. Second is section 54EE. This is related to investment in specified units notified by the central government. Let's take section 54F. First scenario is where you purchase a new house, that is an apartment or an independent house, which you can occupy immediately. It has to be purchased within 1 year before or within 2 years from the date of sale of long-term capital asset. The second scenario is construct a new house, and this can be done within 3 years from the date of sale of long-term capital asset. Conditions. The exemption can be claimed for only one house. You cannot purchase 2 or 3 houses and try to claim exemption for all the houses. The maximum limit is 10 crores. This benefit is only available to taxpayers who do not own more than one house. That is, before purchasing this property, you can own only one house. The property should be purchased only in India, and the property cannot be sold for 3 years after the date of purchase or completion of construction. The amount can be deposited in capital gains account scheme until the purchase of property but before filing of returns. Claiming deduction under section 54F. The least of the following is claimed as deduction. Long-term capital gains. Where the amount invested in new property exceeds the net sale consideration, the entire capital gains. Where the amount invested in new property is less than the net sale consideration, then long-term capital gains into amount invested by net sale consideration. In this case, net sale consideration is nothing but your total sale consideration minus expenses on transfer, that is brokerage expenses. 10 crores. Let's assume you have sold shares for rupees 50 lakhs. The brokerage expenses is 1 lakh and cost of acquisition is 30 lakhs. You have purchased an apartment for rupees 40 lakhs, and this is scenario 1. In scenario 2, you have purchased an apartment for 60 lakhs. Now let's see what will be the exemption. In both the scenarios, the sale consideration less expenses on transfer, you get your net sale consideration for 49 lakhs. Since we assume that the shares have been sold after July 23, 2024, we are not taking indexed cost of acquisition. So your cost of acquisition is 30 lakhs and your long-term capital gains comes to 19 lakhs. In the first scenario, you have purchased an apartment for 40 lakhs. That means you have not used your entire net sale consideration of 49 lakhs. Therefore, the exemption will be nothing but your long-term capital gain, that is 19 lakhs, into amount invested 40 lakhs by net sale consideration, which comes to 15 lakhs 51,020. Therefore, your long-term capital gain is 3 lakhs 48,980. In the second scenario, you have purchased an apartment for 60 lakhs. Since it exceeds the net sale consideration of 49 lakhs, your entire long-term capital gains will be exempt from tax. Let's look into section 54EE. The taxpayer should invest in long-term specified assets notified by the government, bonds of National Highways Authority of India and Rural Electrification Corporation. The maximum limit is 50 lakhs for claiming exemption. You can invest more than 50 lakhs, but you can claim exemption only up to 50 lakhs. The exemption will be withdrawn if the bonds are sold within 3 years, and it will also be withdrawn if a loan is taken against these bonds as securities. The bonds should be purchased within 6 months from the date of transfer. Claiming deduction under section 54EE. Amount invested in specified units, rupees 50 lakhs, and the long-term capital gains. The least of the above is allowed as a deduction. Subscribe to our channel Ayakar Kamkar and mail us for tax consultation at ayakarkamkar@gmail.com. Thank you.